In Chapter 20, we'll cover the accounting issues associated with providing pension benefits to employees. So, at a basic level, a pension plan just means a company is going to pay its employees some retirement funds for, in part for compensation for the services provided by the employees. So how this generally works is a company is going to donate assets into a pension fund. The pension fund is going to be a separate legal entity from the employer, so it's its own company. Right, so part of that is pension fund's going to have its own accounting books. It's going to be separate from the books of the company. The pension fund's then going to take the assets donated to it, and it's going to invest the funds, hopefully earn a return, so it can pay for the future retirement of the employees. The next slide covers qualified versus non-qualified pension plans. I'm not going to ask you about this, so don't worry about qualified pension plans. In general, pension funds are going to be one of two major types. The first is the defined contribution plan. With the defined contribution plan, the employer is just going to contribute some set amount of money every period into a pension fund. The amount they contribute is just determined by some formula, which will differ from company to company. Besides the contribution that the company needs to make to the fund every period, it has no other obligations. So this makes the accounting for these types of pension funds very easy. The contribution each period will simply be recognized as a pension expense and the credit cash for the amount of contribution. So this is very straightforward. For most of this chapter, we're just going to focus on the other type of benefit, our pension plan, which is the defined benefit plan. However, I will mention the trend has been going towards defined contribution plans because the employer's commitment with this type of plan is just very clear. The more traditional type pension plan is called a defined benefit plan. Under a defined benefit plan, the employer is going to commit to pay a certain amount of benefits to each employee. The amount they're going to pay to each employee will depend on some set formula. It will vary from company to company, but generally it's based on the number of years of service that the employee provided and their salary. So again, the employer is going to contribute funds into a pension fund. That fund's then going to invest in assets to pay for the benefits of the employees. Under this plan, though, if the pension fund doesn't provide enough funds to meet the employer's obligation to the employee, then the employer is still responsible for making up the payments. Since the employer is under obligation to pay for the benefits of the employees, the accounting for these types of plans becomes much more complex. The expense we recognize each period won't necessarily be equal to the amount of the cash contribution to the pension fund, and the measurement of the pension liability becomes complex because it relies on future events. So this next slide just gives you an example of a defined benefit pension formula. It's a very simple case, but it just gives you an example of how they might calculate the benefits that need to be paid out. Ultimately, the benefit paid out is going to depend on a bunch of future variables. Again, this gets very complex, so usually we just rely on actuaries for the assumptions and the estimated benefits that need to be paid. So there's two primary issues we deal with when we're trying to account for pensions. One of those is how do we report the pension obligation, otherwise known as pension liability, and the second is how do we determine what pension expense is in any period. So to answer the first question dealing with the pension liability, there's three main measures of the employer's obligation. One of these is called your vested benefit obligation. Vested benefit obligation means that only those benefits that have vested will be used in calculating the pension liability. Vested just means that the right to the pension has been earned, so it can be exercised. Instead of using the VBO or vested benefit obligation, we could also use an ABO or accumulated benefit obligation. In this case, we're including both vested and non-vested benefits. However, we're going to measure these benefits using current salary levels. And then finally, the last way to measure the employer's obligation is called the projected benefit obligation, or PBO. This is the FASB's choice of measurement. This is similar to an ABO, where we're going to use the benefits of both vested and non-vested employees, but we're going to measure these benefits using the expected future salary levels. So calculating the pension obligation is pretty complex. You're not going to have to do that in this class, as it's going to be done by actuaries, but you should be familiar with the big picture of idea of what the PBO represents. So as we saw in the previous slide, the projected benefit obligation of the PBO, this just represents the benefits that will be paid out to the employees. As we went over earlier in the chapter, to pay out these benefits, the company is going to contribute assets into a pension fund. So these assets will be known as pension assets. Again, the pension fund is going to take the assets that it gets, it's going to invest into different types of investments, and hopefully it'll increase the amount of pension assets. So the pension assets are going to be the assets used to pay benefits to the employees. Again, the pension fund is a separate legal entity, so these pension assets aren't going to be reported on the books of the company or the employer. Rather, they're going to be reported on the books of the pension fund. Same thing with the PBO, the projected benefit obligation. This will also be reported on the books of the pension fund. It's not captured in the books of the company. However, the employer or the company is still going to keep memo records of the PBO and the pension assets. Right, so in other words, they'll still keep track of it, but they're not going to have any formal accounting records for this. However, the company or the employer will report a pension asset or a pension liability on their books. Right, so if the pension fund has enough pension assets to cover the projected benefit obligation, then from the company's standpoint, it has a pension asset. So pension asset just means the pension assets are greater than the PBO. On the other hand, if the PBO is greater than the pension assets, then the company then is going to report a pension liability. Right, so here we have an example of the financial statements from Intel. Right, you'll notice they calculate their ending PBO down at the bottom here for 1742, and then they show their plan assets here, how they changed over the period, and they have an ending fair value of 684. So in this case, they have a projected benefit obligation of 1742. Currently, they only have 684 to pay for it. So the plan is overfunded at this point by the difference of $1,058 million. Since this plan's underfunded, it needs to report a pension liability on its balance sheet. So if we go to the next slide, you'll see that they report this liability under its other long-term liabilities in the notes. So we dealt with the first basic issue of what the pension asset or liability should be. Again, it's the difference between the fair value, or I should say the ending balance of the fair value of the plan assets, and the ending balance in the PBO. Again, if the fair value of the plan assets are greater than the PBO, the company reports a pension asset. If, however, the fair value of the plan assets are less than the PBO, then the company reports a pension liability. The second major issue we deal with is what the pension expense should be. We're going to spend most of the chapter dealing with this issue. As you can see from the slide, there are potentially 5 major components to pension expense, and we're going to discuss each of these on the upcoming slides. Before we do that, I just want to point out one thing. If you're following along in the book, when the book first discusses the 5 major components to pension expense, it says to use the actual return on plan assets. This is technically incorrect. You should be using the expected return on plan assets. The book does later on go on to correct itself, but I think this ends up confusing a lot of people. So just to be clear, the expected return on plan assets should be going to your pension expense, not the actual return. The first component of pension expense we'll discuss is the service cost. The service cost is going to be provided by an actuary. As we mentioned earlier, a pension is compensation to employees for the past services they provided. So the basic idea here then is if the employees provide more service over any particular year, the employer is going to be on the hook to pay out more in benefits. So these increased benefits are just called the pension service cost. The second component we'll discuss is the pension interest cost. As we said before, the PBO is the present value of future expected benefits, both vested and non-vested. And we measure these using future salaries. Key word here, though, is this is the present value of future expected benefits to be paid. Anytime we measure a liability at its present value, over time, the present value is going to increase due to the time value of money. Right, so in other words, the present value of this PBO will increase over time, and we're going to recognize that amount as pension interest cost. Right, so we're not going to report this amount separately as interest expense. We're going to include the interest cost in the pension expense. Obviously, the interest rate used to calculate the interest cost will have a major effect on the amount of interest we recognize. For this class, the interest rate will be given to you. Since this FASB doesn't specify how often we should compound interest, we're just going to use simple interest computations in this class. As an example of the interest costs, let's say as of December 31st, 2017, the company had a PBO of $1 million, an ABO of $750, and a $300,000 debit balance and AOCI from prior service costs. The fair value of the pension plan assets amounted to $350 at the beginning of the year. Assume that the settlement rate was 10%. What is the pension interest cost in 2018? So to calculate the pension interest cost, we'll simply take the beginning balance of the PBO of $1 million, and we're going to multiply that by the interest rate. So $1 million times 10% gets us out to $100,000, which is going to be our pension interest cost for the period, and we're going to include that $100,000 in the pension expense. The third component of pension expense that we'll talk about is the return on plan assets. Again, the expected return on plan assets is the component that's going to be included in pension expense and not the actual return on plan assets. The basic idea here, though, is that if a company earns more on its plan assets, it's going to have to contribute less to the pension fund to pay for the benefits of employees. In turn, it should make sense that they're going to recognize less pension expense. We'll talk about the actual return first, and then we'll get to the expected return in just a bit. To calculate the actual return on plan assets, we start with the change in the fair value of the plan assets. However, the change in the fair value of the plan assets is going to include any cash that the company contributed to the pension assets. In addition, if the company pays out any pension benefits, it gets paid out from the pension assets, which reduces the asset balance. So if we're interested in the actual return on the pension assets, we need to back out of any contributions and back out of any benefits paid. So this formula here for your actual return just shows that we're calculating the fair value plan assets, but we're backing out of contributions and benefits paid. Now, again, pension expense doesn't include the actual return on plan assets. The reason why is the actual return on plan assets is going to be very volatile since it just depends on market prices. So if we included actual return on plan assets in pension expense, and pension expense affects net income, this potentially could cause net income to be very volatile. So instead of using the actual return on plan assets, the FASB allows firms to use the expected return in calculating pension expense. We can take the actual return on plan assets and split it into two components, the expected return and the unexpected return. The expected return on plan assets is just an estimate of the return we would earn on the plan assets over the long term. So it's just an estimate or an expectation of returns. To figure out the expected return, it's pretty simple. So let's just assume a company has pension plan assets of 10,000 and the expected return percentage is 11%. So to figure out the expected return, we would just take the beginning balance in the plan assets of 10,000, multiply it by the expected return percentage of 11%, and we're out to 1,100. Okay, so let's just say, for example, in this case, the actual return is 2,000. Our expected return would be 1,100. And so the unexpected return then is just the difference between the actual and expected return. So in this case, our unexpected return is just the 2,000 minus the 1,100. Again, the actual return in any period is generally going to be different from the expected return. If our actual return is greater than the expected return, then we have a gain on plan assets. In contrary, if our actual return is less than the expected return, then we have a loss on plan assets. Let's take a look at a quick example. The balance of IBM's pension fund assets decreased by 3,000 during 2015. IBM made cash contributions of 68,000 and paid benefits from the plan totaling 79,000. If the expected return on the assets for the period was 15,000, what was the gain or loss on the plan assets? Again, as I mentioned on the previous slide, the gain or loss on the plan assets is the difference between the actual and expected return. So the actual return, the plan assets decreased by 3,000 during the period. However, the change in the plan assets fair value will include contributions and benefits paid. So if we want to get to the actual return, we need to back out of the contributions and benefits paid. So the contributions were 68,000. Since these contributions would increase plan assets, we need to subtract these contributions out. Tells us the benefits paid were 79,000. Since if benefits are paid, it decreases the plan assets. We need to add these benefits paid back in. So if we add and subtract everything, we get out to an actual return of 8,000. Finally, the expected return was 15,000. So in this case, we expected 15,000, but our actual return was 8,000. So since our actual return was less than our expected return, we have a $7,000 loss on plan assets. So just to recap real quick, we've talked about 3 of the 5 components of pension expense at this point. Right, so first, we are adding the service costs. Again, the service cost is just the cost of providing another year of service, which in turn increases the benefits that need to be paid out. We add the interest costs. Again, the interest cost is just the increase in the present value of the PBO. And then we're going to subtract out the expected return on plan assets. Right. There are 2 other possible components. So possibly we're going to add amortization of prior service costs, which we'll talk about in just a bit. And then finally, we might add or subtract amortization of gains and losses on the plan assets and the PBO. So this loss or gain on plan assets we just talked about, sometimes it will affect pension expense, other times it won't affect it, and we'll come back to that again in just a bit. The next component of pension expense we'll talk about is prior service costs. Prior service costs arise when pension benefits are awarded retroactively. In other words, a company may sometimes make a change to a pension plan, which in most cases, it'll increase the benefits that will be paid out to its employees. It's possible that employer cannot make the change retroactive, but this is pretty uncommon. The employer could also reduce the pension benefits it's going to pay out, but this is also very unlikely. So even though pensions are compensations for past services, the assumption here is that the changes to the pension benefits may also encourage future services. So in turn, we're going to try to match expenses with the related revenues. So GAAP allows companies to take any prior service costs and spread it out over future periods, rather than recognizing all of the prior service costs as an expense in the current period. So when we first record prior service costs, we'll record it into OCI, or other comprehensive income, for prior service costs. And then we're going to amortize prior service costs to pension expense over the future service life of the employees. The unamortized portion will get closed out into accumulated OCI, or AOCI. We're not going to cover the two possible amortization methods for prior service costs in this class. However, you should know what prior service costs represent, and you should understand the big picture of how we treat prior service costs, which is summarized in the last bullet point on this slide. So far, we've covered 4 of the 5 components of pension expense. The last component is the amortization of gains or losses on plan assets and the PBO. We'll talk about the plan assets first, then we'll move over to the gains and losses on the PBO. So the gains and losses on plan assets we talked about earlier when we covered the expected return on plan assets. We'll just do a quick refresher here. So again, the unexpected return on plan assets is equal to the gain or loss on plan assets. And the unexpected return is just the difference between the actual return and the expected return. Right, so if our actual return is greater than our expected return, then we have a gain. If the actual return is less than the expected return, then we have a loss. Again, this gain or loss won't be immediately recognized in pension expense. So just an example here, let's say the fair value of plan assets of Google equals $200,000 as of December 31st, 2014. In 2015, the expected return is 7% and the actual return is 10%. What is the gain or loss on the plan assets? So to calculate the expected return in 2015, we'll take our beginning balance of plan assets, which in this case is $200,000, and we'll just multiply by the expected rate of return, which is 7%. So this will get us out to $14,000. The actual return, we can do the same thing here since we're given an actual return percentage. We'll take the $200,000, we'll multiply by 10%, which gets us out to $20,000. So in this case, since the actual return is greater than the expected return, we have a gain on plan assets of the difference of $6,000. Again, the $6,000 gain is not recognized in pension expense immediately, whereas the expected return of $14,000 will be included in pension expense. Another gain or loss that may affect pension expense is the gain or loss on the PBO. We haven't talked about this component yet. So earlier we said how an an actuary will estimate the value of the PBO by using several assumptions and estimates, and a bunch of these depend on what's going to happen in the future. Chances are that they're going to have to change these assumptions from period to period as to get more information. Right? They have to update their expectations. For example, actuaries might change something like retirement ages, future salaries, life expectancies, and so on. If an actuary changes one of these estimates or assumptions, it's going to increase or decrease the PBO. So if the estimate decreases the PBO, this suggests that the company will have a lower obligation in the future, so they have a PBO gain. If, however, the change in the estimate decreases or increases the PBO, that suggests that there's going to be a greater obligation in the future, so then we have a PBO loss. Just like with gains and losses on plan assets, these gains and losses on the PBO will not be immediately recognized in pension expense. So on the last two slides, we talked about two things: gains and losses on plan assets and gains and losses on the PBO. Again, these two components are not immediately recognized in pension expense. The reason why is that both of these items tend to be really volatile. In the case of plan assets, this depends on market prices. In the case of the PBO, it's going to depend partially on market prices, but it's highly dependent on estimates, which are going to vary quite widely. So both of these components are volatile. So if we made firms include these immediately in pension expense, it caused pension expense to be pretty volatile, which in turn would cause net income to be volatile. If a firm's net income is volatile, it generally sends the sign that the firm is really risky. Obviously, firms don't like this, so GAAP allows companies to essentially smooth out the effects of these items on net income. To smooth out the effects of these items on net income, the company is going to report these gains and losses into the same account, and they're going to report it into an OCI gain and loss account. This OCI gain or loss account, as hopefully you remember from Intermediate 1, right, this will be closed out into AOCI. Now the idea here is when this OCI account is greater than some calculated amount, the excess here is going to be amortized into pension expense. Right, and so in particular, if the AOCI gain or loss account is greater than 10% of the beginning PBO or the fair value plan assets, whichever is larger, it'll be amortized into pension expense. In this class, we're not going to go over this amortization technique known as the corridor method, but you should understand how to treat the amortized portion of the gains and losses on plan assets and PBOs.